It is Sunday, March 22nd, 2026. The markets are officially closed. Trading desks are quiet, screens are dim, and yet silver has continued to move. Since Friday's close, it has dropped another $2.75, bringing it down over 4% during a period when most people assume nothing is happening. Silver is now sitting near $64, 93 per ounce, and gold has also slipped, holding around $4,130. What matters right now is not just the price itself, but the fact that the selling did not stop when the market closed. It continued quietly, almost unnoticed, over the weekend. That detail is more important than it looks, because when price action continues outside normal trading hours, it often tells you something about the kind of forces driving the move. And in commodity markets, not all declines are the same. Some declines mark the end of a bull market. Others are violent interruptions inside a much larger upward trend. The difference between those two scenarios is not obvious from price alone. It is hidden beneath the surface in the structure of the market itself. So the real question is simple, even if the answer is not. Is this decline the end of the silver bull market, or is it a temporary breakdown caused by mechanical forces that will eventually reverse? To answer that, you have to separate emotion from data, because right now the emotional response is obvious. A drop from $121 in January down to roughly $65 in less than 2 months feels like collapse. That is a decline of over 46% in a very short time. Moves like that don't happen often, and when they do, they usually belong to a very small category of market events. But history shows that those events can lead to completely different outcomes. In some cases, they signal the end. In others, they set the stage for the most explosive rallies that follow. The key is understanding what is actually driving the selling. There are two main types of sell-offs in commodity markets. The first is structural. That happens when the underlying reasons for higher prices disappear. Maybe supply suddenly increases, maybe demand falls, or maybe monetary policy shifts in a way that makes holding commodities less attractive. When those conditions change, the market resets to a lower level, and the decline is justified by fundamentals. The second type is mechanical. This is where things get interesting. Mechanical selling is not driven by changes in supply or demand. It is driven by forced actions, margin calls, liquidity crises, currency spikes. These forces push investors to sell assets regardless of their long-term outlook. It becomes a chain reaction. People sell not because they want to, but because they have to. And when that happens, price can disconnect from reality. That disconnection is where opportunity is created, but it is also where confusion is highest. Because while the price looks weak, the underlying fundamentals may not have changed at all. To figure out which scenario we are in, you have to start with supply. And this is where silver stands apart from almost every other asset. Unlike gold, which is mostly stored and preserved, silver is consumed. It is used in electronics, solar panels, electric vehicles, medical devices, and countless industrial applications. Over time, that silver does not come back into the market. It gets dispersed, embedded, and effectively lost. Estimates suggest that the vast majority of all silver ever mined has already been used and is no longer recoverable in any meaningful way. That creates a very different supply dynamic compared to gold, where most of what has ever been mined still exists in some form. At the same time, production has not kept up. Mining output has been relatively flat, and new projects take years, sometimes a decade, to come online. Even with high prices, the pipeline of new supply is slow and limited. So what you have is a situation where demand is steady or growing, while supply is constrained and slow to respond. Now consider what happened just a few months ago. A massive amount of physical silver was withdrawn from major exchange vaults in a very short period of time. Tens of millions of ounces were taken out, and yet the price barely reacted. That alone tells you something important. The physical market and the paper market are not moving in perfect alignment. Large amounts of real metal can leave the system without immediately affecting the price you see on the screen. That kind of disconnect does not last forever. Now shift to the monetary side, because this is where the comparison to past cycles becomes critical. In 1980, the last major silver boom ended with a collapse, but it did not happen randomly. It happened because interest rates were pushed extremely high. And when safe government bonds offer very high returns, holding non-yielding assets like silver becomes less attractive. Money flows out and prices fall. But today's situation is very different. The global financial system is carrying a massive amount of debt. Raising interest rates aggressively would increase the cost of servicing that debt to unsustainable levels. That limits how far rates can realistically go. In other words, the tool that ended the last commodity boom may not be available this time. At the same time, inflation pressures are still present, especially in energy and food. Rising costs in those areas ripple through the entire economy. And when inflation remains elevated, commodities often benefit over the long term. So now you have two key pieces of the puzzle. a constrained supply situation, and a monetary environment that does not easily support aggressive tightening. That combination does not look like a classic end-of-cycle scenario. Now look at the behavior of related assets, particularly mining stocks. These companies are highly sensitive to the price of silver and gold. When metals rise, miners often rise even more. When metals fall, miners tend to fall harder. Right now, mining stocks have dropped significantly. Technical indicators are showing extreme levels of selling pressure. These are not normal conditions. They are the kind of readings that tend to appear during panic-driven sell-offs. And there is a specific pattern forming. After a strong rally, prices have returned to a key breakout level. In technical terms, this is often called a retest. If that level holds, it can act as a foundation for the next move higher. If it fails, the market may need more time to stabilize. So this level matters, not because it guarantees anything, but because it helps define the structure of what is happening. There's also a broader perspective to consider. The mining sector currently represents a very small portion of global equity markets. Historically, during major commodity cycles, that share has been much larger. If even a small reallocation of capital occurs, the impact on mining stocks could be significant. It does not require extreme assumptions, just a shift in positioning. Now bring everything together. The price has fallen sharply. That part is undeniable. But the factors that would normally justify a long-term collapse are not clearly present. Supply has not suddenly increased. Demand has not disappeared. The monetary environment has not shifted in a way that strongly favors alternatives. Instead, what you see is a rapid, aggressive decline that carries the characteristics of forced selling. That does not mean the bottom is already in. It does not mean the price cannot go lower. Mechanical sell-offs can continue longer than expected. They can overshoot. They can test patience. But they are temporary by nature. Eventually, forced selling runs out. Positions are cleared. Leverage is reduced. And when that process ends, the market begins to reflect underlying fundamentals again. That is the transition point, and it rarely feels comfortable when it happens. For anyone who has been holding through this cycle, this is the difficult part. Watching gains disappear, seeing volatility increase, hearing negative sentiment grow, it all creates pressure to act. But the key question remains the same. Have the underlying drivers changed, or has the price simply moved? Right now, the data suggests that the core drivers are still in place. Supply constraints remain, demand remains, monetary limitations remain. What has changed is the price and the mechanism behind its movement. Every major commodity cycle includes sharp declines along the way. These declines often feel like the end when they are happening. They attract attention, headlines, and strong opinions. But in many cases, they are part of the process, not the conclusion. That does not remove risk. It does not guarantee outcomes. Markets are complex, and uncertainty is always present. But understanding the difference between structural change and mechanical pressure helps create clarity. And clarity is what matters most in moments like this. Because when you strip away the noise, the situation becomes easier to evaluate. Not easy to act on, but easier to understand. Silver at $64, 190th prior, is not just a number. It is a point within a much larger structure. A structure shaped by supply, demand, monetary policy, and market behavior. Where it goes next will depend on how those forces evolve and how the current selling phase resolves. For now, the data points toward a market under pressure, but not necessarily a market that has lost its foundation. And that distinction makes all the difference.